Good day, fellow investors. Yesterday we discussed these stocks, and by looking at the stocks that are related to the US economy, it is clear, given their negative guidances, that we might be at the brink of a recession. This from a bottom-up stock analysis perspective. What is going on? Interest rates could be starting to finally bite everyone, tariffs are there. It could be just a natural recession that hasn't happened for 15 years. And now the question is, okay, how to prevent it? Can we prevent it with money printing, with lowering interest rates? What to do, invest in gold, how to invest? Let's start discussing. Smash that like button if you haven't. So the first shock in the news there, not the guidances of the companies, but if you look here, the payroll adjustments, so unemployment is going up. Economic growth rebounded after the negative quarter, but is still 1.25% in the first half. Spring pending home sales hit year low, thus tariffs are biting, home sales down, GDP impact. Jamie Dimon says that we don't yet know whether this is a weakening or a recession. It's impossible to predict, of course, but it's good to know where we are. And then there was this comment on Bloomberg, everything looks still resilient, the consumer health hasn't cracked yet. Monetary policy leaning towards easing, that is the current situation, everything looks good. The key question is, how will this look like a year down the road? Because then is when it can happen. We have sluggish summer for US labor market, unemployment rate going up, and look at this, each time the unemployment rate started to go up, we had a following recession. Now, given the pandemic shenanigans, the unemployment rate started already to go up significantly for a year or two, but no recession yet. But this has been a clear indicator in the past. When the recession ends, it's much higher, and that is then growing during the recession. So just an indicator of slowing down economic activity, which is again normal. Manufacturing activity has shrunk for a while, and why we haven't yet had a recession despite all the indicators there, that's because of debt. Because if we look at government spending, that's around 17% of GDP. That money goes to people, entitlements, also consumption, that's all GDP. And now, we have had a boom of GDP for the US in this case, based on net exports, as people were forcing imports here before Liberation Day. That has rebounded, and okay, that has been the biggest beneficiary to economic growth. However, if we look at the indications, it's not really green, it's going more towards the orange-red, and that is already something to think about. Speaking of unemployment, which might lead into a recession, the huge AI investments will lead to job losses over the next year, 2 years, and that in combination with huge deficits from the government, where the government needs to spend 2 billion a year extra to borrow, to keep the spending here, just to keep the GDP growing. Deduct the government deficit here of 2 billion from the yearly GDP plus the multiplier, and the US economy is 10% lower. That is how the debt affects the economy. We'll see how that impacts over the long term if interest rates force the government to borrow less. For now, everyone expects rates to go down and everything good, but that works until there is a shock. We had no recession even if the yield was deeply inverted, unlike in the past. However, this is now extremely manipulated, as we see in the news, with politicians getting involved with the Fed. And the idea is that there will be no recession because the Fed will simply lower rates. And there is this constant attack of the Fed, how whatever they are doing is wrong, and even Trump thinks incompetence is more important than to defend theoretical independence. So Trump wants lower rates so that his interest payments and things like that go lower, it helps the economy, etc. And that is also what the market expects, lower rates, and everyone thinks that lower rates will do well. What if lower rates don't have an impact? What if the Fed lowers rates and there is still a recession alongside inflation? That is the key issue there. Then you can print money, push inflation higher. At some point, all these monetary policy tools don't work anymore. And that is where we have to start fearing for the current financial environment. I wish I could predict it, but it is key to understand that these rates have not yet impacted the economy. We are still living on the benefits of the hugely low interest rates here from the past. This is not yet impacting, and already everyone wants to see it lower because net interest payments for the government are becoming unsustainable, because this is a Ponzi scheme when you need to borrow more money to pay interest on your debt. How to solve it? You go and print. Printing to ease the debt, of course, the rich get richer, the poor get poorer. You allow for inflation, your pension fund invested in bonds gets obliterated, and that's how it goes. Plus, speaking of unemployment, everything this higher debt, deficits, everything stable, is based on stable decade projections from the budget office. What if there is a recession and this goes to 9% here, and there is a decline in real GDP growth? Then everything here gets disastrous. If we look at debt over the last 20 years, it is a 4x. This is what is keeping the economy higher. So sooner or later, we'll have to see a recession. Then you can print more, but if we look, the debt was 4x. If we look at wages, it's just from 20 to 36 higher. If we adjust for real term those wages, over the last 20-something years, from 341 to 376, there has been no real growth in wages. And the question is whether you will go to work next time the government prints more money and you are not getting a wage increase, a real wage increase. That is the big issue. This situation that we are living in is clearly unsustainable. Whether the next recession will come in 6 months or not, that's not predictable. We will see, but we have to be ready for a big recession ahead, because the later it comes on unsustainable fundamentals, the bigger it will be. How to invest? Be hedged. Warren Buffett is hedged with $350 billion in cash, waiting to buy things on the cheap when the things crash. You have to ask yourself whether you have an anti-fragile portfolio. We discussed this in my stock market crash strategy that can be based on fundamentals. I have a very strong hedge in my portfolios where if the market crashes 50%, I will go 3x. That is also something, but for that you need to check my research platform, focus on fundamentals, see to own things that will do well no matter what. Berkshire is a great hedge, but now it's expensive, as we discussed in this other video. The key is that whatever happens, you are okay. If a recession comes around in the next 6 months, 5 years, when it will come, that whatever happens, you can still accumulate wealth. You can own businesses that will still give you good yields to reinvest and lower prices and accumulate more assets over time. So we need to take advantage of those recessions, see for hedges, see whatever you can do, but be ready for anything. If you want to check what I do, how am I protected, check my research platform in the link in the description below. There is a 21-day money-back guarantee. It will give you the best context to all this YouTube channel, to all the risk and reward. I'm fully invested in the stock market. That's also something you should know. But check it there, see whether it could add value over the next decade from a value investing perspective to your wealth accumulation strategy, and then tell me whether it is or not. No hard feelings.